So if you can take us through that and help us understand what exactly cost segregation is.
Yeah, look, cost segregation is a way for real estate investors to pay less in income taxes by speeding up how fast they're going to write off parts of their building. You started getting into it earlier. Normally, the tax rules say that you have to depreciate or write off your buildings really slowly. For residential rental property, it's over 27 and a half years. For other commercial properties, 39 years. But not everything in the building lasts that long. And so, of course, the tax rules are complicated, and there's different categories of types of components in the building, along with different tax lives that you get to depreciate them over.
Welcome back to the Wealth Vibe Show, where we tune into the frequency of wealth creation, protection, and expansion. I'm your host, Loomba, and today's episode is going to open your eyes to a whole new layer of wealth strategy most people completely overlook. We're diving deep into the world of tax credits, incentives, and cost segregation, and how the smartest investors are using these tools to unlock massive tax savings and grow their wealth faster. Today, our guest is a true pioneer in tax strategies for real estate investors. Gian is the former president of American Society of Cost Segregation Professionals, co-founder of KBKG, and one of the few experts who actually testified before the IRS on cost segregation. With over 25 years in the game, he has helped thousands unlock serious wealth through strategic planning. So today, we'll be discussing how to build wealth with strategic cost segregation. Welcome, Gian, to the show. I'm really excited to have you with us today.
Thank you so much, Vicky. I'm excited as well, and thanks for the great introduction.
Thanks. So a little bit about cost segregation is the strategic tax planning tool that allows real estate owners to accelerate depreciation by reclassifying parts of a building into shorter life categories, typically 5, 7, or 15 years instead of standard 27 and a half or 39 years. And with talks of 100% bonus depreciation making a comeback, cost segregation is once again taking center stage as a powerful wealth building strategy. So let's start at the very beginning. Gian, let me ask you this question. What pulled you into world of tax strategy and cost segregation? Was there a moment when you realized this was the true wealth unlocker?
Well, listen, I fell into this world, and if you wanted to go all the way back, it's really I went to school at Purdue University to study civil engineering, construction, structural engineering, actually, and sometime in my third or fourth year, I decided I don't think I want to sit behind a computer and design steel beams and bolts to for buildings. I wanted it to be a little more client facing. And so I knew that I ended up finishing my degree in structural engineering, but wanted to find a job outside of that. And so I ended up working for a firm called Arthur Andersen, formerly one of the biggest CPA firms in the world, accounting firms. And right now there's the big four accounting firms. Back then it was the big five.
Mm-hmm.
And so Arthur Andersen was looking for construction engineers for their cost segregation practice. So 25 years ago, really there wasn't a lot of expertise, people that knew how to do cost segregation studies. And so the big accounting firms had teams of people doing these types of things for casinos, for big pharmaceutical manufacturers that had huge investments in real estate and building huge projects. And so that's how I got started in cost segregation. Really, at the very beginning of my career, been working with a lot of real estate clients. And really, when I left the Big Four, that's really when I started to um, work with smaller investors that, you know, I was really helping put money back into their pockets as opposed to the big, huge Fortune 500 companies. And I could tell how much of a meaningful difference it was making for these folks. And so, that's how I ended up here. We founded KBKG about 25 years ago, and um, you know, back then there wasn't a lot of companies doing what we do, and now we're one of the biggest cost segregation firms in the country with offices from coast to coast. Um, and yeah, that's how I got here.
Nice. So let me ask you this question. Can you tell us what cost segregation is actually? Like I said, it's like you're kind of segregating the components in a building, but sometimes it's not 100% true, or we do not have the complete clarity. So if you can take us through that and help us understand what exactly cost segregation is.
Yeah, look, cost segregation is a way for real estate investors to pay less in income taxes by speeding up how fast they're going to write off parts of their building. You started getting into it earlier. Normally, the tax rules say that you have to depreciate or write off your buildings really slowly. For residential rental property, it's over 27 and a half years. For other commercial properties, 39 years. But not everything in the building lasts that long. And so, of course, the tax rules are complicated, and there's different categories of types of components in the building, along with different tax lives that you get to depreciate them over. And so things like vinyl flooring, cabinetry, appliances that you're buying in a multi-unit, multi-family building, even things outside the building can be depreciated much quicker. And so really the cost seg study is an analysis. Usually it's by an engineer that breaks up the property into all its different pieces. It's putting a value to all those pieces and allowing you now to write off all of it in year one instead of over decades. And so the name of the game is really accelerating your tax deductions, taking them all now instead of spreading them over the future. And it provides a huge financial benefit. It's a time value of money benefit to get your deductions now. And I think I always like to put numbers to it, Inky. And so let's say you have a $270,000 rental property that you acquire. And normally if you buy, let's say it's a $300,000 property, and 30,000 of that is for land. And what you're left with is 270,000 for the building and improvements. You're not supposed to depreciate land, right? So you put that off to the side. And under the normal rules, you would get a $10,000 tax deduction each year for 27 years on a residential rental property. That's without cost seg. Now, if you did a cost seg on that same property, you could get as much as 25% of that building value to fall into these categories that are eligible for bonus depreciation and can be written off in year one. So that's $54,000 now with a cost seg study compared to the $10,000 without. So that difference, that $44,000 of additional deductions you get, is a very significant benefit for that type of building.
Wow, it does. So when you do the analysis, I'm going to ask you a follow-up question on that, just to get some more clarity. How do you decide the timeline for a component or a fixture, if you can guide us a little bit?
Yeah, it's all statutory in the tax code.
Uh-huh.
Um, and so, of course, there are some gray areas because there's going to be components in certain buildings that can be used for a bunch of different purposes. In the tax rules, it basically comes down to the purpose of the component. And so, in general, if the purpose of the component is to support the general maintenance and operation of a building, if it's structural in nature, those are the things that have the long life, right? So even things like a bathroom water heater has a long life because it's serving the general operation and maintenance of a building. But other things, things like cabinetry in certain types of buildings, removable flooring, um, things outside the building are considered land improvements, asphalt paving, and so on. Those would get a 5, 7, or 15-year tax life under the tax code.
Interesting. And one more question is here. Do you do the cost segregation only on the investment properties, or can you do that on your primary residence as well?
You're not allowed to depreciate or write off your primary residence, so it is only income producing property, investment property, yes.
Interesting. You might have worked with thousands of CPAs, business owners, or the real estate investors. What is one of the single, I would say, the most common mistake you have seen people making that could cost serious money?
Well, when it comes to cost segregation, I think in we can simplify how it's applied, and I always like to preface that you really do want to get your tax advisor to agree that this will make sense for you. There's been situations where I've seen investors engage a cost segregation study um, and maybe not completely benefit from it because of their tax situation. And
Mhm.
so you'll definitely want to make sure you're working with a firm and making sure your CPA firm understands the tax ramifications, especially if there's things like 1031 exchanges involved. Cost seg can work very well with 1031 exchanges, but if you're not careful, you might not benefit at all in a 1031 exchange. So it does require some knowledge up front about the situation.
So can you take us through that journey? What would work with 1031 or what won't work with 1031 exchange?
Well, okay, so here's in general, we do a ton of cost seg studies on properties that have been involved in a 1031 exchange.
Mhm.
So most of the time it's going to work. Here's a situation where it doesn't work. Let's say you have owned a property for 20 years. You know,
Mhm.
it, in that case, and let's say it's a residential rental property that you bought for $1 million 20 years ago. Because the residential rental property, you get to depreciate it over 27 and a half years. You're already in year 20 of depreciation for that property. So what that means is you don't have a lot of depreciation left. You've already depreciated, you know, I don't know, 60, 70, two-thirds of it, let's say. And so if you started with $1 million, you might be down to, I don't know, $333,000 of depreciation left on that property. So let's say if you do a 1031 exchange now, you exchange that property into a new property, and let's say you bought the new property for $1 million. Um, your tax basis, how much you get to depreciate on that new property is impacted significantly by how much depreciation you had left on the property that you relinquished. Okay. And so if there's only $333,000 left that rolled into the new property that you bought for a million, there's that's all you get to depreciate. And so, I've had situations where somebody used another cost seg firm, did the cost seg study on their new property that they bought for a lot of money, but they didn't have a lot of tax depreciable basis left on it. And so when they got to the end and they took it to their CPA and said, "Here you go, now put it on the tax return,"
Mm-hmm.
CPA called me up. I had to explain how it all worked, and they had to deliver bad news to that client that, yeah, you're actually not going to get these deductions because um, the cost seg firm didn't understand, the basis. They didn't investigate and talk about or ask questions about the old property that you exchanged out of. So I know that was a long answer, but yeah, that's kind of a situation to watch out for.
No, but that's a good answer, though. But let me ask you the bases again. What are the bases and what cases exactly, if you can reiterate that you won't get the tax or the cost aggregation there for the new property, then you're doing 1031 exchange? Because a lot of times when you come in, you're going to be improving the property, right? And it's going to be the new loan again. So basically starting ground zero as a new owner for the property. So I think I missed that. On what basis you were saying that you cannot do the cost analysis going to be different?
Well, look, if it all depends, if you're exchanging out of a property
Mm-hmm.
that doesn't have a lot of depreciation left on it, right? It, let's say you sold a property for $1 million and there's zero depreciation left on it because you've owned it forever. Okay.
Mm-hmm.
If you buy a property for $1 million, a new one,
Mm-hmm.
there's no cost seg opportunity. There's no basis to depreciate. But if you bought, let's say, a $3 million property, right? Now you have there's excess basis here. Now you do get to a bunch of new depreciation, right? So anytime you're moving up in properties and you're getting a new loan and putting new money into it, that's where the depreciation comes from. And that's going to be the situation most times, right? People trading up into bigger properties
Mm-hmm.
where there's going to be more depreciation. You just have to be careful when you're not trading up so much, and you have to really look at how much depreciation was left in the old property that you relinquished.
Mm-hmm. Interesting. Yeah, something to learn more about. I know most people, when they hear about cost segregation, they immediately get a little bit confused. So, can you explain in like simple terms, why do you think it's such a powerful tool for accelerating wealth?
Look, I work with thousands and thousands of real estate clients over my lifetime, and we all know that real estate can build wealth. I think what a lot of people don't fully realize is how much the tax rules are kind of slanted towards real estate, and how much a lot of the sophisticated real estate investors, like the really, really billionaire type investors, are utilizing depreciation and cost segregation to essentially, pay very little tax. Um, Obviously, President Trump, when he was running, never wanted to show his tax return, and he wasn't paying. He doesn't pay much tax because he essentially uses this tool to shelter a lot of income,
Mm-hmm.
like a lot of real estate investors do. And look, if you know the tax rules and you're utilizing cost segregation to your advantage, uh, you can really avoid paying tax as a real estate investor. So yeah, it's a powerful strategy.
And when you mentioned Trump, I wanted to ask you this question now. There is a talk of 100% bonus depreciation potentially returning. If that happens, what does it mean for investors and how should they be preparing for it?
Well, it has happened. The bill was just passed July 4th.
Mhm.
It's called One Big Beautiful Bill and full of different tax changes. And one of the ones that you're talking about, bonus depreciation, is back to 100% for any properties purchased after July 20th of 2025. If it was purchased in 2024, I want to say that the bonus depreciation rate, I think, was 60% in 2024,
Mhm.
but it jumps back up to 2025. And so that means when it comes to cost segregation, you're getting a lot of deductions in year one. Just makes it um, very easy to, not easy, but makes it easier to tax plan when you know that you're getting this big chunk. I can go buy a property and essentially, depreciate right off maybe 20% of it in year one.
Mhm. So how does it, from an investor perspective, how does these depreciation or the bonus depreciation work for the investors who are passively investing in the real estate syndications?
Yeah, this is another area that you really need to understand your tax situation. Um,
Mhm.
there's passive real estate investors, and then there's non-passive or active real estate
Active. Mhm.
professionals.
Mhm.
And when you're a real estate professional under the IRS tax rules, it opens up a lot more friendly tax treatment for you, where you can utilize deductions from um, your real estate against other non-passive income. And so, I think you just need to be a little more aware and careful as a passive investor. And so, I think probably the best example is, let's say you're a software engineer that work for Microsoft and you're making $300,000 a year as an employee. You get a W-2 um, or a W-2 employee with a paycheck. If you go out and buy a real estate investment property and you do cost seg and you create a bunch of paper depreciation losses, you're not going to be able to use those deductions from your real estate against your W-2 income
Mhm.
because you're a passive investor.
Mhm.
Um, but if you had, several real estate investment properties in that same situation, let's say software engineer owns five real estate properties and he's owned them for a while and they're cash cows, they're spitting off income and he's starting to have to pay tax on that real estate income. If that person goes out and buys another property and creates a bunch of depreciation losses, he can use those depreciation deductions on the income from other real estate investments. And so that there's some planning that you have to do there and understanding of your tax situation. Um, there are some ways around that rule, and happy to get into those if you want to go down that road, Vinky.
Yeah, definitely. We'll love to hear that because our listeners will like that. Because I know when you're a full-time employee, you cannot write off against your W-2, but you can definitely write off your capital gain because it's a capital gain and paper capital losses, which can offset each other, right? But beyond that, we'd love to hear your expert opinion, how people can leverage those paper losses if there's a way to do that.
Yeah. Well, is one thing that people should be aware of is if if you're married and your spouse is let's say making a bunch of money, let's say $300,000. He's a software engineer. And then the other spouse is considered a real estate professional. That's what they do. And they meet the criteria. That criteria, by the way, is 750 hours or more doing real estate activities and essentially managing real estate properties that you own. If they meet that criteria and you file jointly your tax return, then you can use the losses, depreciation losses from your real estate against that W-2 income that we were talking about. Okay, so that's one situation where you have a couple. One is a real estate professional, one isn't, and you can net the losses with your non-passive income. So it's all considered active. Of course, you have to have a spouse that actually does meet those rules. It's not easy to meet those rules, and I wouldn't advise trying to. You just want to look into it very closely as to whether you could qualify. My personal opinion is if you own, probably 25 units or more with your spouse, and you're not using a third-party management company, you're getting into that area where your spouse is probably spending 750 hours or more dealing with that. But yeah, it would be very difficult to meet that criteria if they're managing like 2 or 3 units, like
Or
extremely difficult.
investments. Yeah, even investments too, right? It's just like how many hours you're spending in real estate, basically, and
Right.
that could be in any aspect, right? Does not need to be necessarily managing properties. They could be buying or selling real estate too, right?
Yeah, it gets complicated with the rules, and it isn't any type of real estate activity. There's specific activity that's excluded from the definition, and I don't want to get into too much on this show, but I would just say you would want to explore those rules in detail if it's something, and talk to a tax professional.
It's always a good idea to talk to the expert on it to get into
Yeah.
deeper to understand everything before getting into anything. But thanks for sharing that. So let's shift the gears here a little bit. I was reading in your bio that you have provided the expert witness testimony to the IRS and published in top journals. That's a rare air. What did it take to reach that level, and how did your mindset have you evolve or grow into this role?
Well, when we started KBKG, there weren't a lot of firms that did cost segregation at the time, and we were getting a lot of opportunities to speak in front of CPA societies like the California Society of CPA, the Texas Society, national tax shows for CPAs, and so just kind of constantly being on the road and educating really the tax community about how cost segregation works and all the different strategies and what they should be thinking about with their clients, I think was kind of a natural way to get recognition. Sometime around 2006, between 2006 and 2008, the American Society of Cost Segregation Professionals was formed, and I was heavily involved with that. And once I became president, it had more of a higher profile. But I got asked by a very large taxpayer to become the expert witness in their case that was going to federal tax court. The IRS was challenging whether, really for an apartment building, this was related to an apartment building, whether all the components inside the apartment building should be eligible for a shorter tax life. And it's interesting. There's one case that went to court on that issue,
Mm-hmm.
and it's kind of it's a very interesting case. But most experts refer to it as bad case law because the taxpayer didn't have any incentive to defend themselves. And so what ended up happening in this case is the IRS got to litigate a case with a taxpayer that didn't care about the outcome. And the judge ruled in favor of the IRS. Now, this isn't the case that I was involved with. This is one that happened before I got put on a different case.
Mm-hmm.
Anyway, so it's bad case law. It's called Amerisouth, and the IRS still kind of uses that and points to it and says, "Hey, you're not supposed to depreciate certain things in your apartment buildings over a shorter life." Anyway, so the case that I got chosen for was a large corporate company with a lot of apartment investments. Same exact issues that the IRS wanted to. It was scheduled to go to federal tax court. I was working with a team of attorneys out of Washington, D.C. And of course, in this case, the taxpayer was wanting to defend it and had an interest in defending everything. And so the IRS settled the case, and we got a very favorable result settling that case literally a week before it was supposed to go, and I was supposed to testify. And what I kind of learned from that was that the IRS doesn't like to take things to tax court if they feel like they might lose.
Oh.
If they feel they have a very strong case, they would have loved to have taken that to tax court so that they could have a favorable opinion that they could always point to, right? Once that precedent is set, like they can always point to it. But if they don't like their odds, they will settle it, and so going through that process and getting all the way to the end and having them pull out and settle just gave me a really good understanding of how they really feel about their positions when trying to argue against cost segregation for apartment buildings.
Yeah, so that helps you maybe structure or do your analysis better, like and fine tune it how you can make the best use of it. So beyond cost seg, what tax credits or strategy do you think are most overlooked by multiple investors, but could be like incredibly valuable that people are not using?
Well, for multifamily developers, you mentioned, Vinky, earlier, you talked about even low income tax credit, affordable housing developers. Should definitely look at the tax credit under Section 45L. And that tax credit is worth up to $5,000 per unit. So if you have a 50-unit building that is considered energy efficient, you could get as much as $250,000 in tax credits there. Unfortunately, the big Trump tax bill that just passed last week, it wasn't favorable for a lot of energy tax incentives, and that was one of them that they essentially accelerated the phase out of. And so now for that specific credit, you have to essentially have the project completed by June 30th of 2026.
Until next year.
Yeah. There's another incentive for building owners. Again, it's related to energy efficiency. That one's under Section 179 capital D. and that one's worth $5.65 per square foot of the building area. And so it's good for larger buildings like warehouses that are 50,000 square feet or more.
Mm-hmm.
Um, and that's a deduction. So if it's 100,000 square foot warehouse, you could get as much as $565,000 in deductions if it's energy efficient. Again, big tax bill that was just passed accelerated the phase out there, and that is only available for projects that have started where construction has begun by June 30th of 2026.
Oh, interesting. That one is going away too, huh? June 26th. Let me write that down. Good. So let's talk about something that makes some investors nervous, the depreciation recapture. For those who are not familiar, especially limited partners, how does the recapture work, and what do they need to understand about it when they're participating in a deal that's using cost segregation, which is basically each and every deal in multifamily because we like to use cost segregation.
Yeah, so recapture is basically whenever you're accelerating depreciation on any asset, whether it's real estate or a piece of equipment, um, you're going to get to take those deductions and you get those at your ordinary tax rates. When you're selling the asset, you're supposed to essentially recapture or pay back the tax that you saved up until, up to the point of the asset's value. And so basically what it means is that if you're buying a building and you do a cost seg study in year one and you accelerate, say, $200,000 of depreciation deductions, if you flip the building the following year, you accelerated $200,000 of deductions. So you maybe at, call it a 50% state and federal tax rate, you saved 100 grand. When you sell the property, if you sell it the next year, you have to essentially pay that back, that $100,000 in tax savings. And so cost segregation will not make sense when you're flipping a property very fast and you're selling for cash. So you buy a property and you're planning on selling it in the first 3 years for cash, probably doesn't make sense to do cost seg. But if you are going to exchange it, then it's a non-issue. So
Carry over. Mm-hmm.
yeah, it just keeps deferring. So if you bought a property in year one and you accelerated depreciation, and then in year two you sell that property in an exchange,
Mm-hmm.
you continue. You don't have to pay back. You don't have the recapture issue. There's some planning that goes into that, which I won't kind of dive into, but you should just know that you can avoid paying the recapture tax with some planning from your cost segregation firm that you're using.
But I think you did touch on that a little bit when we were talking about 1031 exchange earlier. So that clarifies right here because we came to the full circle now. About how I was asking about the bases, I think that's what you explained a lot better over there. So just tune into the whole episode, guys, to understand all the golden nuggets that Gian is sharing with us today. I wanted to ask you another question. Most people view taxes as a burden, not a strategy. So today, whatever you're talking about is all very strategic. You're talking about it's a strategy. So how do you talk to people or your clients to flip their mindset and start seeing tax planning as a core part of wealth building?
I think fortunately for me, a lot of my clients are referred to me by their tax preparers,
Mhm.
and so they already have that kind of mindset in a lot of cases, and they've already been kind of sold that this is a something they really need to look at. So yeah, in general, by the time they kind of get to me, they've kind of already done a lot of the research and kind of understand the benefits of doing this. Um, but of course, there's situations where they're not quite sold, and for whatever
Mhm.
reason they want to pay the tax or feel like that they're going to have to pay the tax at some time. And so, that's the thing with cost seg that I should kind of emphasize here. Cost seg isn't creating new deductions; it's just taking them earlier, right? And so some
Mhm.
people think, well, if I'm just going to take, you know, stuff deductions from the future, that means I lose them in the future, right? And so I don't want to do that because I'm just, now I'm going to lose deductions in the future. Well, the problem with that thinking is that there's just huge financial value, that time value of money, because you can take that tax savings and invest it in new properties. Okay. And that's where the value is. If you're planning, if you just you're not planning on doing anything with that cash, you're just going to put it under the pillow, and there's really no cost, there's no value to cost seg
That's
because
it. Mhm.
yeah, I mean, yeah, if you're going to put it on the pillow and do nothing with it, then yeah, cost seg doesn't make sense.
That's true. And I know I'm getting the reason I asked you that question was because I know I was talking to somebody within my family and friends, and then I did mention this bonus depreciation and cost segregation, how you can get the people losses. And this was so funny. The person, the way she answered that to me, she's like, "Oh no, we like to pay taxes. If you make money, you have to pay taxes." So at that time, I was just thinking maybe people are thinking there is some ethical issue they have in their mind. That's the reason I wanted to ask you how you handle the mindset of the people when they come to you with those kind of mindset. And the follow-up question for you is on that. What role does ethical responsibility play in advanced tax planning? How do you balance aggressive strategy with long-term integrity and trust? I think that's
Mm.
where the question that was on the example that I'm giving you earlier, that boils down to that because it's kind of set in stone in a lot of people's mind that if I'm making money, I have to pay taxes.
Yeah, good question. Look, when you're dealing with tax strategies, tax incentives, the business that we're in, ethics plays a huge role in this because
Mhm.
there's a lot of gray areas. And the best piece of advice that somebody gave me years and years ago was to always do the right thing. And it's one of our core values. And we really emphasize that here at KBKG. You have to make sure that your clients aren't taking risks that they don't know about, that they shouldn't be taking. Um, and yeah, like I said, I mean, there's some bad actors out there in the world of tax credits and incentives that unfortunately you know do fraudulent activities in terms of uh, telling or selling clients on tax benefits that um, they shouldn't be. And so, yeah, as far as answering your question, and how do you balance that? You just you have to have the mindset that as a company you're going to do the right thing, and we've always done that. And look, you've heard of the great benefits with cost segregation. This is all legal stuff. It's all written into the tax code. There's no need to get super aggressive to where you're you know in that area of unethical kind of that conversation. So just do the right thing. I would encourage that for taxpayers, the CPAs we work with, and all of the employees at our company.
I think the bottom line is people have to start thinking a little bit mind shift right there is not considering as a tax burden, but thinking as a tax strategy. Basically, whatever's written in the tax law, you're trying to leverage that. And it's something bringing to your experience, to your knowledge, how to leverage that and make it worthwhile for yourself. For our last question, I'm going to ask you for someone early in their journey, maybe a small business owner or a first-time investor, what's one practical step they can take today to start protecting and growing their wealth through smart tax planning?
Well, look, one piece of advice is just make sure you are working with a tax professional that really understands your business. There's a lot of CPAs and tax pros that are generalists, and they have, couple hundred clients, and they're just all over the place, right? And working in this industry for so long, like it's impossible for a CPA to understand all the rules and how all the rules apply to all different types of clients. Really difficult. And so the CPAs that focus on a specific niche, like whether it's they're the CPA for manufacturers or distributors or retail or real estate. I mean, if that's your business, if it's real estate, you really want to make sure that the CPA that you're working with has a very strong niche in real estate.
You said it very well. Everybody has their own story. So you need to see, what does to connect in your story to make it happen for you. So this brings us to our rapid fire round, which is going to be fun and insightful. I'm going to ask you 5 questions. You have to answer it one word or one sentence only, whatever comes to your mind first. So it's going to be really fast. Okay. Are you ready?
Yeah, I'm ready.
All right. So the first question, what's the biggest tax myth people believe?
The biggest tax myth that people believe?
Mhm.
Well, I guess it's that I'm stuck paying the bill, and there's nothing I can do to change it.
Like I said, if you're making money, you have to pay taxes. One book every investor should read.
You know, Obviously, the one that changed me, and I read it when I was young, was Rich Dad, Poor Dad. And I know a
Okay.
lot of real estate um, investors have read it, but if you haven't, it's a must read.
Real estate or stock market.
Real estate.
Most surprising place cost segregation can be applied.
Uh, Golf courses.
Oh, wow. In
Yeah,
the last,
golf. Yeah,
because I thought golf courses are all land, but it's kind of super nice to hear that golf courses you can apply cost
yeah.
too. I think it's basically the clubhouses. That's the
Well,
reason that people have clubhouses, maybe.
Well, no, so even the tee boxes have these drainage systems underneath in the greens can all be depreciated. So there's millions of dollars in the tee boxes, greens, irrigation systems, certain areas that are landscaped. Um,
I was just saying, how about the lakes or the water bodies that we see
y-
in the courses?
yeah, if they're man-made and they have some kind of membrane under them, then yes, they can. There's depreciation benefits to man-made water features and lakes.
Interesting. So the last question, wealth means,
Wealth means comfort.
I like
I don't
that.
I don't want to say happiness, right? Because that's but comfort.
That's a really good answer. I like that. This was such an insightful conversation, Gian. Thank you so much for breaking it down the complex strategies into more kind of digestible, bite-sized information, I would say. So before I let you go, how can people reach out to you and learn more about your work at KBKG?
Yeah, a couple things here. So we developed a software, right, for smaller residential rental properties that users can do it themselves, right? So normally these cost seg studies on bigger buildings, they can cost, $5,000 to $10,000. But
Mhm.
for smaller residential properties, 6 units or less, you can use our online cost segregation software and get it done for $500.
That's
And yeah, and so it's you can find that at costsegregation.com, right? And if you type in uh, this this promo code, you can get 10% off for first-time users, and that promo code is VIBE 2025. So, and it's all caps, VIBE 2025, to get 10% off for first-time users. And the website is costsegregation.com. And would love it if your listeners, could find me on LinkedIn. I'm the only Gian Pazzia, actually in the entire world. So you will find
wow.
me on LinkedIn, Gian Pazzia, Gian Pazzia, Pazzia.
Interesting. That's what I say about myself. I say always, I'm the only Winky Loomba in the whole world.
Oh yeah, yeah. And by the way, our company KBKG, you can find us on the web. I'm on there. And if you need help, we can certainly help as well.
Great. Thank you so much. I really enjoyed our conversation today. And everybody, until next time, stay in the frequency of wealth. This is the Wealth Vibe Show, where money meets mindsets and strategy meets spirit. See you guys next time. Thanks again, Gian.
Thanks, Vinky.
Thanks for tuning in to the Wealth Vibe Show. If you enjoyed the episode, be sure to subscribe and leave us a 5-star review. And don't forget your free gift. Download the Busy Professional's Guide to Real Estate Investing at loombainvest.com. See you next time with another amazing guest and another powerful conversation.